there are bits and pieces of news on the macroeconomic front in the coming week. The most important ones are probably going to be UK inflation figures on Wednesday the 17th of February, and then the latest GfK UK consumer confidence reading on the 19th. Just by way of a reminder, December's readings for inflation were as follows. The Consumer Price Index, or CPI, rose 0.6% year on year, up from a very modest 0.3% advance the month before. The Bank of England's preferred measure, CPIH index, which includes housing costs, that rose 0.8%, and the now discarded Retail Price Index, or RPI, also rose by 0.8% year on year. Now, digging deeper into those figures, the biggest price increases came from petrol, computer games and clothing, while food prices were broadly down, notably cauliflower and ham for any gourmets among you. Now, I guess the increase in petrol was the most eye-catching figure, especially as oil prices have gone up even further since, and the combination of higher prices at the forecourts and a low base from pandemic pummel 2020 means inflation could start to tick higher. Economists think we could even see inflation rise to between 2 and 3% at some stage this year, above the Bank of England's target, especially if the economy gets going in the wake of the vaccination programmes, although the central bank's still hardly likely to dash to increase interest rates anyway. If anything, it seems keener to cut them from an already record low of 0.1%. In terms of consumer confidence, the last GfK survey gave a score of -28, down a fraction from December as the country went back into lockdown. It'll be interesting to see if the administration of more than 10 million vaccine doses is giving any boost to confidence, although it may now be a matter of all eyes on the government's latest policy statement on the 22nd of February with regard to how and when lockdowns might be eased. The coming week should also be informative when it comes to company news. Dates which may be worth noting in your diary are as follows, although please do note that they can still be subject to change. Minor BHP Group on Monday the 15th of February, and another minor, Glencore, on the 16th. British American Tobacco and Silver Digger Hochschild Mining on the 17th. Smith & Nephew on the 18th, when Barclays will also be the first of the big banks out of the blocks, with then another bank, NatWest, up on Friday the 19th, alongside real estate investment trust Segro. However, the stock that could really cause a fuss in the week ahead is Rio Tinto. The mine is due to publish its full year results for calendar 2020 on Wednesday the 17th of February. Now, the shares are up by nearly 40% over the past year, buoyed by higher raw material prices, hopes for an economic recovery, and nagging worries that inflation of all things may be lurking round the corner. This will be the company's first set of results under new Chief Executive Officer Jakob Stausholm. The Danish national, formerly the company's Chief Financial Officer, took the helm on the 1st of January following a resignation of Jean-Sébastien Jacques. His 3.5-year tenure had ended abruptly amid the uproar caused by Rio Tinto's destruction of 2 rock shelters in the Yukon Gorge, a sacred Aboriginal site in Australia, just so it could expand an iron ore mine. Mr. Stausholm has already shaken up the management team at the iron ore business in Australia and at company board level to help re-establish the company's environmental, social and governance credentials. Analysts and shareholders will no doubt look to him for any early pointers on group strategy too, especially with regard to Rio Tinto's reliance on iron ore, the troubled and expensive expansion of a huge copper project in Mongolia, and also the company's carbon footprint, where offloading its coal assets has already been a huge step forward. However, the ultimate focus will be on the full year numbers, where the miner's preferred earnings metric is EBITDA, or earnings before interest, taxes, depreciation and amortisation. On an underlying basis, the analyst consensus is looking for $23.6 billion for 2020 and, in the event Mr. Stausholm gives any guidance for the coming year, $26.6 billion for 2021. Those figures compare to $21.2 billion in 2019. In terms of business mix, Rio Tinto's biggest earner by miles is expected to be iron ore at nearly $19 billion of our EBITDA, followed by aluminium at $2 billion, copper and diamonds combined at $1.8, and then energy and minerals. Now, at least then you really know what makes Rio Tinto tick, and it's iron ore, and which commodities prices to look out for when assessing the company's fortunes going forward. Attention will then switch to the cash flow and balance sheet. Rio Tinto has massively strengthened its balance sheet in the past few years, and net debt's expected to come down to around $1.7 billion, compared to nearly $20 billion a decade ago. thanks to higher profits, disposals of assets, and also a drop in capital expenditure. CapEx is creeping up again after a big decade-long dip to around $6 billion in 2020, and it could reach 6.8 in 2021 and 6.7 in 2022, although even then, analysts still think Rio may have a net cash balance sheet in 2 years' time. That all then leads into the dividend. Rio Tinto is expected to offer a full-year dividend of $4.80 a share in 2020, up from $4.43 in the prior year, with an increase to $5.94 US cents in 2021. Now, if that forecast for 2021 is right, that puts the shares in a forward dividend yield of more than 7%. As a final point, Rio Tinto did put its lavish buyback scheme on hold in 2020 once the pandemic struck, but it has been pretty generous here in the past. The man has bought back some $18 billion of stock on top of $39 billion of dividend payments in the past 10 years. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.